Okay, onward with magic tax planning. Yes, let's go start with that screen. Now, we're back with magic tax planning in the RCF education seminar. One of the things I want to point out is effective tax planning doesn't always mean zero taxes. It may mean, like Arthur Godfrey, I don't mind paying the government taxes, but I'd like to pay half what I do. I think that if you look at the capital gains rates, you see some of that magic. I'm going to say this. You can challenge me on it, but I think virtually no one should pay 20% capital gain taxes. Virtually no one. If they have that much capital gain, it's almost certain they should be using opportunity zones, which is one of our 4 remaining tax planning strategies here. And if you say, well, they're going to pay a lot of capital gains tax because they have so much ordinary income, then what do you think I'm going to say? Don't they know about retirement plans? Remember, in 2013, to refresh your memory, who was president in 2013? Barack Obama was starting his term. And most people incorrectly, and I'm going to definitely put that point home, said defined benefit plans are dead. Well, defined benefit plans are dead or on life support for corporate America. Having said that, who are defined benefit plans most useful for?
People getting close to retirement.
Well, and people who are self-employed, own their own businesses. I think probably the worst abused industry, Boo, is real estate salespeople. There are a lot of real estate salespeople who make $500,000 to several $1,000,000 a year selling real estate. And I bet not 1 in 20 has a defined benefit plan. Every one of them should fire their tax consultant. That's a pretty strong statement. Because that makes 0 sense. If they're over 55 or so, maybe even over 50, they should be looking seriously at about a defined benefit plan. I know Bhupendra agrees with me. He's recommended it to a number of people. I just don't understand a real estate person making $750,000 a year, 60 years old, just paying the taxes on that income. Are they going to be making $750,000 for the rest of their life? Of course not. Deferral has a lot of advantage. But then deferral combined with Roth conversion has even far stronger advantage. Let's say, Boo, that we have a 60-year-old going to work 10 more years. Put it into the defined benefit plan for 10 years, and then at 70, stop working and start every year converting some of it to Roth. The savings could be not in tens of thousands, but in what? Hundreds of thousands of dollars. So oh, if I fail to advise my client to take a look at a defined benefit plan, and they're a real estate agent or a consultant making $750,000 a year, then I'm not worth what they're paying me. They might as well have my favorite Roger image sitting at the fireplace at Thanksgiving throwing $100 bills in. But in the case of this person, I suppose I ought to inflate that number. They're throwing thousands of dollar bills into the fireplace. One of the things that I hope to do in this opening 6 hours is not only show you 6 really important tax planning concepts, but then in January through April, when I do the 2-hour webinars, I'm going to do case studies showing combining those 6 strategies. And that's where I think AI is going to eventually do away with people like me. The good news, Ben, is by the time AI gets to that point, I won't care. I'll be retired, or worse, I might be 6 feet under it. But the opportunities. I know a lot of people who say, well, I don't put much attention to tax planning because who cares? It's not worth the effort to save $100 or $200. I never focused on saving $100 or $200. It needs to be thousands of dollars. Although for some people, hundreds of dollars is a big deal. If you're trying to put food on the table, hundreds of dollars is a big deal. So managing that capital gain rate is very important. Notice, does it anywhere here say, I added it at number 2, that married couples, the limit is exactly double. But I also have a note that if you do defer a portion of capital gains through an opportunity zone, it may be possible to have some totally non-tax capital gains and some deferred gains. It is that combination, Alan, that is the magic. It's not just people focus on one thing at a time. That was something when I was a professor. And let's see, Alan's one of the few. Alan and Marion in here, I think, are the only 2 that had me as a professor at the University of Georgia. People complained. Some people complained. You didn't have me, did you? Did you?
Did you complain?
People complained. People complained about a couple things. Number 1, that I like to teach 8:00 classes. I told you the story earlier of the lady who is now a close personal friend who was a student at the University of Georgia, bachelor's and master's, and never had me for a class. And she told me that. I said, Kim, why did you never have me for a class? And she's a lady, but she said, you like to teach those damn 8:00 classes. But another thing that people complained about is you couldn't just read the book and do well in my courses.
That's why I like
You just that wouldn't do it. Because so much of what I taught was lecture. You only got it if you came to lectures. So if you were somebody who wanted to just stay at home, read the book, and do well in my exams, you didn't do well. So I had a reputation of being tough. The truth was, I wasn't tough at all. I was easy. But you had to go to class. At 8 o'clock in the morning. Well, you should be fresh at that time. But I also like, and that's what this section's about. This is so important. But I can't do it with the lecture. I have to do it with the add-on of the add-on of the online stuff that I'm going to do in January, February, March, and April. Because in those, I might take 3 or 4 of these 6 techniques and use them on one person to show how much we can save in tax savings. Because that's what can make you special. If you have an idea or have good ideas on, I think there's something to do about this. When you see somebody that owes $75,000 in taxes, Vic, you ought to be thinking, how could they owe 50 or 40 or 30? Because these first 2 things out of the 6, there is an opportunity not to defer taxes, but to what? Eliminate taxes by paying no tax on Social Security, paying no tax on capital gain. So the final point on capital gain is the one that's up here on the screen. The Goldilocks combination of capital gains might be opportunity zone plus 0 taxation. Don't get lazy. They got a $600,000 capital gain. Don't think they should put $600,000 into an opportunity zone. That's probably wrong. Probably it should be 570 or something like that, because the other 30,000 might have the opportunity to be what? 0 tax. So it's a combination thing. And that's going to be my challenge. That's going to be my challenge to you in January through April, if you're on my webinars. And I think it's so important that I'm even willing to give you credit toward next year's continuing education if you give me an example that I can work on. And your client will get a double benefit because they'll get my work free. You get to charge them, of course, but they'll get my work free, and you will get a benefit.
Have you ever taught on Section 1202 stuff?
Yeah, there is.
I might have 2 or 3 years out.
There is so many opportunities here, and here's another one. I have this myself this year. I have some short-term capital gain by accident. Because short-term capital gain gets taxed how? As ordinary income. Of all the capital gain I might have, what's the one thing I should put in an opportunity zone? Short-term capital gain. These strategies make you a hero because, well, I can't say it to you, Boo. You're retired like Ben and I. Well, Ben isn't retired, come to think. But think about it. If you, Tom, can recommend to your client something that saves them $10,000, and 90% of your competitors would not have done that, that makes you a mega hero, doesn't it? That means you're Superman or Spider-Man or whatever. Which I jokingly will tell you, but boy, do they earn it. I refer to the two ladies that are helping me with the seminar this year. Well, for 40 some years, I've referred to Susan as Wonder Woman. With Mary, she's a rookie. So I'm calling her Wonder Woman 2. She wants to be Wonder Woman 1, and I said, you're 40 years late to be one. But think about these possibilities. Nobody should be paying these outrageous capital gain rates. Just doesn't make sense. Next slide.
Next slide.
Okay. This I've already started to tell you this. Short-term capital gain rates are taxed as ordinary income. If people are not taking advantage of the opportunity zone rules for short-term capital gains, I say, why not? And what you're going to find out in another section that I do here is they re-upped the opportunity zone rules this year. July next year, Governor Kemp, will he still be in office? Yeah. No, when he goes out in January, doesn't he? We have an election for governor coming up. Oh, it's next November. So it's going to be Governor Kemp. And the other 49 governors next July are going to have to declare the, quote, new opportunity zones. The rules are going to be different, but I'll tell you what they are in the later section that I do. But the rules are going to be different. But here's a powerful thing you need to hear several times. They put in what's called a rural. I guess I'm yelling, right, Renee? I'm too loud.
You're putting everybody to sleep out there.
Well, I would not be putting people to sleep. They would be complaining about loudness. Twice. I was in a San Francisco hotel one time doing some training for Bank America. There was a Baptist revival next door. And the guy that was doing what Jam's doing today, was taping it, said, no problem. You can outshout them any day. I didn't consider that much to be a compliment. I don't know that I don't consider that to be a compliment now. I was at the University of Georgia doing a retirement seminar for them long after I was on faculty there. I didn't do their retirement seminars when I was on faculty. I started the year after I left. I guess when you're at home, you're not an expert. But once I was no longer on faculty, then all of a sudden I became an expert. And for 25 years, I did all the exit seminars for the university. One time we had 125 people in the new Classic Center. It's not new anymore, but it was at that time. And the mics went out. And there was a Baptist revival next door. And I was plenty worried. But the person who went, oops. And of course, it's a scam call. And the person who was doing the seminar went next door to the Baptist revival and said, no problem. They're complaining about you. So maybe it's good that I'm dramatic. I don't know. This is very important. I don't understand why people pay ordinary income rates of 35%. on a capital gain. I don't understand that. Why wouldn't they do an opportunity zone? I'll tell you why they don't, and it's not a good reason. They don't because they think it's going to be 10 years till they get their money back. Right? But they're wrong, aren't they? Another thing I have in here is one of my 6 tree techniques is loans. Loans are a great source of cash flow in retirement. Why are they a great source of cash flow in retirement? Because they're non-taxable. I'm sneaky. I just snuck by you a way to destroy your reservations about reverse mortgages. I just stuck it by you because the money you get out of a reverse mortgage is a loan. It doesn't count as taxable income. And best of all worlds, Marion, it probably never will count as taxable income because of either stepped up basis or sale of principal residence. Reverse mortgages are loans on personal residences. So why in the world not take advantage of reverse mortgages? I know why people don't. Let's talk about some of the reasons why people don't. And unfortunately, we have Mr. Magic tomorrow or Friday afternoon, Dan Holquist talking. I'll have him more in the next couple of years. I have the good fortune of being a good friend. But Dan's magic. Dan has a really hard time. Dan's a very nice man. So he wouldn't be like my cat. If you don't do what my cat thinks, my cat will look at you, meow at you, like, are you an idiot? Don't you know what I want? Dan doesn't do that. But I know what he wants to do. He wants to say, why do people not understand and not take advantage of reverse mortgages? Some of the greatest financial planning that can be done in retirement is with reverse mortgages. But if you fail to understand them, I'm fortunate. I'm so old that 20 years ago, I finally said, I need to take a fresh look at reverse mortgages. Because to that point in time, Belinda, reverse mortgages had been terrible. Financial institutions had been ripping people off on reverse mortgages. That was, and Dan will say this very clearly, that was before Jack Kemp. Jack Kemp, well, let me give all the things people would say about Jack Kemp. Jack Kemp was not a brilliant quarterback, all pro for many years. The ladies in the audience would say, one of the best men you ever saw. What you don't know about, most people don't know about Jack Kemp is he was one of the most intelligent men that ever lived. He had an IQ, it was north of 180, I know that. I don't know what exactly it was. Had he been president, he might have had the largest IQ of any president. Of course, Ronald Reagan beat him in the primaries. And people who know me know I admire presidents of both parties who have one single characteristic. They don't think they're the smartest person in the room. They hire people who are smarter than they are, and they are comfortable working with those people. So, who are some of my favorite presidents? And this is not a political statement, as you're going to see Democrats and Republicans on this list. One of my first ones is John Kennedy. Kennedy was brilliant himself, but that may have been the most brilliant cabinet of all time. He had people like Kissinger and people like that, who by the way, was a Republican before John Kennedy. John Kennedy had a brilliant cabinet, not the least of which was brother Bobby, who was a good bit smarter than John. John was no dummy. He was probably 150, 160 IQ. Bobby was north of that. And I still think one of my favorite movies of all time. If I like a movie, I don't watch it one time or even three times. I might watch it a dozen times. The movie about the Cuban crisis, which included Kevin Costner, is one of my favorite movies of all time because it shows just how the mindset of John Kennedy worked. He relied on people who were at least as smart as he was. He took their advice. Another Democrat. You're going to be surprised that I hold this one with high admiration, was Bill Clinton. Bill Clinton had the same characteristic. Bill Clinton, unlike, I'm going to get in trouble for this statement, unlike his wife, did not have a large ego. So Bill Clinton had Rubenstein on his cabinet. Rubenstein had been the chairman at Goldman Sachs, yes. And Rubenstein was so brilliant financially that very early in Clinton's term, he announced to his cabinet that if there is a financial issue, only one vote counts. And it's not mine, he said. It's Rubenstein's. And Rubenstein was, history's now saying, the second greatest Secretary of Treasury. It's pretty hard to beat Alexander Hamilton, who created our banking system, which the rest of the world has never, ever been able to improve on. That's pretty significant, isn't it? In the 1700s, we had a man who was so brilliant creating our banking system that the rest of the world, 200 plus years later, has never been able to improve on. So we'll forgive Rubenstein for only being judged as the second most brilliant Secretary of Treasury. But it's not just the two Democrats, because that's not my politics at all. Although I loved it when Joe Kernan on CNBC one morning said, well, that's the most intelligent thing I've heard since that last great Republican president, Bill Clinton. Because in 2025, Bill Clinton would not only be considered conservative, he'd be considered far right, wouldn't he? He was a Southern Democrat. Les Nunn was a Southern Democrat. So my next president that I admire so much, as I said, is Ronald Reagan. Ronald Reagan had people like Jack Kemp on his cabinet.
Let me break you for just a second.
Oh, sure.
For those folks online, it's time to text us your name and address. You want to hold that for a minute?
What they asked me to do. Ah. Uh, who are some other great presidents? It's those who are, I'm not going to say Donald Trump. John Adams, yeah, same kind of thing. It's people who are willing to surround themselves with other people who know more than they do and can be, in sports analogies, like the quarterback who knows how to take advantage of Jim Brown. Now, I know there are a number of you old enough to know Jim Brown. Jim Brown is probably the greatest running back of. I will show my University of Georgia loyalties by saying we had one there recently. I think before he's done, we're going to say Brock Bowers is the best tight end in history. 3 years in college, 2 years winning for best tight end, 3 years All-American, all 3 years All-American. Last year broke all the tight end rookie records, and he's been injured most of this year. Played first half the first game, had 100 yards rushing in the first half. Receiving in the first half. Got hurt. So he hadn't played until Sunday. Sunday, he had one of my buddies, who's a State fan, said was one of the career games of all time. Caught 12 passes for 127 yards Sunday on his first game back. Surrounding ourselves with people who know more than we do, taking advantage of using other people's talents is a secret. You need to be the quarterback. But use AI and these concepts to help clients save money. That's what they think they're hiring you for. They don't know that most tax professionals view themselves as just a historian. Put the numbers on the form correctly. Pretty soon, we won't need you to put the numbers on the form correctly. They'll just input them into a computer, and out will come a return that is probably better than most tax professionals do now. More air-free. So to stay relevant, we got to do something different for them. We have to change. That professor I said, who was the greatest influence of any professor I ever had on me, who I thought at the time was an old man who should retire. But looking back, I now think, what a great service he did to me. He made me realize, no matter how old I get, and I'm pretty old now, no matter how old I get, be willing to change. And I see it everywhere in life, where people much, much younger than I am don't want any change. You might as well sit down in your chair and wait to die if you're unwilling to accept change. So there's opportunity here that's unbelievable. Let's go to the next slide. Okay, collectibles. Collectibles have a special rate. Ugh, it's a 28% rate. What can you do? Huh? Right. So now there is a change on 1202 this year. That's right, Kelly. We're not ready to talk about that yet. But 28% on collectibles. And that's what a lot of people have. Gold and silver. I have a friend of one of my good friends who bought a lot of silver last year. I'm reluctant to give you any sort of investment tips. I'm not that business. But you might want to buy some silver. I didn't say gold. I said silver. Why did I say silver? Anybody know what the big trend in silver is? What's Trump been focusing so much on? Rare earth? Rare earth is an enormous need for AI, for these, you can't call them calculators. What should I call them? Mega computers, but they're not that big anymore. But the really powerful AI tools. Yeah, quantum computers. What's our big concern in the United States? Who controlled most of that over the last 20 years? China. And in negotiating with Trump, and I wouldn't want to. Whatever you say about Trump, he's one tough negotiator. If he could get the Chinese to buckle under, he could get anybody to buckle under. And we had a rare earth problem. Can you get me a Coke, Ben? We had an enormous rare earth problem, about 2 months ago? China announced those export taxes on ships coming out of China with rare earths. What's happened in the last 2 months? First, we found somebody to be a competitor for China. You know what it is? Are you watching the news enough? Yep, Australia. Australia is Spider-Man or Superman to the rescue. Australia is going to be an enormous source of rare earth to us. But we have rare earth capabilities in the United States. What don't we have? We don't have the manufacturing process. So we're trying to build it. What's the one common material that's important in that type of data processing? It's silver. So there are many people who think in the future it isn't going to be gold that's going to be the metal of need. It's going to be silver, because I don't know why, Lord knows, I get accused of not being able to screw in a light bulb. I have my strong points and I have my weak points. One of my weak points is technology befuddles me. But I do know from what I hear how important silver is in that process. So there's a collectibles tax and that's what happened to my friend. She bought silver. A year later, she had a 70% profit, and she wanted to sell. And I said, well, you're going to pay 28% federal tax. You're going to pay Georgia tax. So you're going to pay more than a third of your gain in taxes. It's a capital gain tax, so you should know where I'm headed. OZ, absolutely, Reg. And here's the beautiful thing. It takes 10 years for an OZ to get to the point where there's no tax on gain, which means from the time you invest it to the time you dispose of it after 10 years. But what can happen along the way? Here's what people who don't understand opportunity zones don't understand. If they give you a loan on it, Alan, zero. Because it's a loan. So, yes, I get frustrated. There's times when I want to be like some of these colorful people on television, and I just want to scream idiot to people who are sitting there telling me, Brad, it takes 10 years to get liquidity on an opportunity zone. It takes 10 years to get final liquidity, but what if they can refinance earlier? We have a lady coming this afternoon, Amy Kelly. I invite them and let them be a sponsor because they've had incredible opportunities. And they have one that I particularly like. It's a downtown office building in Cincinnati. Doesn't sound very exciting, does it? First place, this office building was the model and done by the attorneys, or by the architects. Wow, what a slip of tongue, Roger. Done by the architects who designed the Empire State Building. This building in Cincinnati predates the Empire State Building, Alan. And guess what? They just made the Empire State Building larger. Same blueprint. And these people it was an office building, primarily an office building in downtown Cincinnati. These Wharton geniuses, and they are geniuses, but they're a whole lot younger than Ben and I, probably at least 30 years younger, probably 40 years younger. These two Wharton guys are the country's geniuses at converting buildings. And what does the United States need? I suppose maybe in competition with rare earths. What do we need worse than anything else in this country? It's going to shock you. Housing. Two of the most populous states in the country, in the Sun Belt, both have enormous housing problems. California, what's the one on our side of the country? Florida. Governments in most states have had to give away enormous advantages to people who would build housing for all the people that are moving there. Now, after last night, Florida may have to close its borders.
Texas is okay. Texas is going to tear it up 100% there.
Because of all the people who are going to want to get out of New York. And it's already been an influence. Amy's boss was a third-generation New Yorker. Big-time Wall Street person. Made hundreds of millions of dollars. His family never would have thought of leaving New York. But for the last 4 or 5 years, he's called Orlando home. When I talked to him earlier this week, he was complaining about the temperature in Orlando because he was out watching his young sons play soccer in Orlando. And I said, Steve, maybe I remind you that your family lived for 150 years in New York. In New York right now, temperature-wise. And Steve has the same problem I do. My one big health problem is I'm allergic to cold air. If I breathe it, I break out in hives. I have to sit down or I might pass out because I'm so allergic to cold air. So find me if you see me live in January and February this year in Florida. Because I've figured out, Melinda, that it's 20 degrees warmer in any of the Florida cities that I considered than it is in Atlanta in January and February. Now, I wouldn't want to be there in July, but in January and February, I can tell you, because I've looked it up, average highs for Orlando, Tampa, Sarasota, etc., are in the low 70s. Average lows are in the high 50s, or in the low 50s. I can deal with that, and will be dealing with it in January and February. I do everything I do out of Florida these days, the consulting. But this is the kind of thing we have to adjust to. So opportunity zones are not what most people think. We could do opportunity zones to postpone the tax on art, coins, gold and silver coins, any sort of collectible. In my case, as you know from those of you who've been, it's sports cards. Yeah, Susan knows me well. So she likes to put things into her slides that she knows about me. She's known me for 40 plus years. So she does an enormous job. And because when she left me, when she had the nerve to get married and move to Atlanta, when I was in Athens, when she left me, she worked for 12 or 15 years for a professional speaker who spoke 250 days a year. She prepared all the materials for him. When I hired her, I pretty much lost a lot of her time because there were 11 other trainers and they all wanted Susan to do their work. So she's that good. But the collectibles, 35% tax, why pay it right now? Short-term gains, collectible gains, and it's not limited to 28% either, is it? If your ordinary income rate is higher, it's not 28%. It's your ordinary income rate. And as you saw in this slide, we also have the problem of the Obamacare tax, the 3.8. I don't know if that will live, but for right now, it's living. And that's another reason to defer capital gains. I don't understand why we haven't done more opportunity zones in this country. Now, the opportunity zones are changing next year. They've tightened the standards. You are going to have to really be an area that needs help. So the population requirement to be a rural, for example, is 50,000. But rural gets a 30% first year step up in basis. So if somebody's got $1 million capital gain and they buy into a rural opportunity zone, they immediately get $300,000 of non-taxable future income. That's pretty good. And it doesn't have to be horrible area. I'm going to give you an area. It's going to sound like I'm already living in Florida with my examples. But because I've been doing so much consulting in Florida, I can tell you a lot about Florida cities by now. One of the ones that is shocking is Ocala. Ocala is almost certainly going to be what? A rural opportunity zone. One of the most impressive facilities, in my opinion, and many people's in the world, is in Ocala, Florida. Anybody know what it is? Grant. Boy, you are on top of it today. The World Equestrian Center is more than spectacular. It's almost unbelievable. A trucking family named the Roberts, with a lot of money. I won't say it irreverently like some people do. More money than they know what to do with. The lady had two basic loves other than family: horses and dogs. And so Brad can tell you, you go into the cafeteria, what a terrible thing, into the restaurant area or the hotel area at the World Equestrian Center, the walls are plastered with portraits and paintings of horses and dogs. Because, She has been a huge fan. And if you want a nice place to go in the winter, where the rooms are reasonable, I hate to be a disloyal Georgian, but this happens when you get to be 70-something years old. I'm blanking out on the name of the place in South Georgia that everybody likes to go for conferences, etc. Huh? Yeah. The World Equestrian Center makes that look like a day's inn. Literally, it does. Say it again. The cloisters. The cloisters are nice. They're also very expensive, aren't they? The World Equestrian Center's about 60% as expensive. And the cloisters did hold the World Leaders Conference. And one of the great things in the cloisters, you could go into the table that was made for them to sit at. And you can sit at that table, which is pretty spectacular. But for modern day things, the World Equestrian Center is well worth going to Ocala for. And if you want to take a family member and show them a nice couple days relaxing time, it doesn't get much better than the World Equestrian Center. In peak time, it might be $250 to $300 a night. In slightly off peak time, it's about $150 a night. I stay in a lot of places around the country with all the traveling I do that charge $250, $300 a night, Bobby, that aren't anywhere close to as nice as the World Equestrian Center. And the cafeterias, oh my gosh. The two eating areas at the World Equestrian Center, well, actually, there are three. I keep forgetting the outdoor eating area. There's an outdoor eating area. There's a wall eating area, which is pretty nice. That's where you normally have lunch. But if you eat where you can see the equestrian activity with the glass view like this, that's even more spectacular. And if you choose to, you can sit outside and eat, Bobby. And there's generally probably 10 months out of the year, 11 months out of the year, there's some sort of equestrian event going on. I don't know what you would call it. There were world-class people jumping horses and gates and things like that when I was there the last time. I've been there probably half a dozen times, and I will tell you, little sleepy Ocala, Florida. The primary real estate person in Ocala is the man who built, oh boy, Boca Raton downtown. His family built Boca Raton 50 years ago. 20 years ago, the family decided somebody needed to move to Ocala. And Scott chose to be that person in the family who moved to Ocala. He says, I used to call it Slow Cala. Now I call it Go Cala. And it's because of the World Equestrian Center. Horse people spend a lot of money. Horse people, to say that they are, what term would I use? They are passionate would be a gross understatement. Horse people go crazy over the World Equestrian Center. It's well worth going there. Well, the point of, I'm not doing this just to tell you about Ocala, because I don't care about that so much. What I am doing is saying that's an example of what rural opportunity zones are all about. Ocala may or may not make it as a rural opportunity zone next year. Why? Because it's growing so fast. This is not a 10% a year growth rate. This is more like a 50% a year growth rate, Reg. And within a mile of the opportunity zone that I know about that is being developed in Ocala, has a new Amazon facility, a new FedEx facility, delivery center, a new Google facility, all within 2 or 3 miles. So there are areas. Let me take another area in the country. And I particularly like this one. You would never think this. Casper, Wyoming. Why Casper, Wyoming? Because it certainly qualifies as an opportunity zone. But Scottsdale Mint moved there. If you know anything about Scottsdale Mint, you'll know that Scottsdale Mint is the largest private mint in the world. Largest private mint in the world. That's pretty impressive. Because the day I was there, they took me on a tour of a group called Wyoming Reserve, which stores the mintage for Scottsdale Mint. They also store the mintage and the coin reserves for more than 20 countries in the world, including England, France, a lot of European countries. In Casper, Wyoming, believe it or not. Do you think Casper, Wyoming might qualify as rural? Yeah. And how big a risk is a place that does nothing but store gold and silver for other people? That's not a big risk, but it is a big need in the country to encourage people to help develop those reserves. So those are two very offbeat examples that I would give you of rural opportunity zones that are probably still going to be rural opportunity zones under the new law. I am enthusiastic about the new opportunity zone rule. Now, some people are not. Some people are thinking, oh, they restricted what can be an opportunity zone. Now I'm going to pick on Alan. Downtown Asheville is not going to be an opportunity zone under these new rules. Why did I do that? Because there was a lot of downtown Asheville that was an opportunity zone under the old rules. The old rules are not over. Close to over, but not over. You can still invest in the other opportunity zones through the end of next year if they still have supply. So now you have two sets of opportunity zones. And you'll see some more of that probably in the discussion from Amy Kelly this afternoon. Her group does Cincinnati. They don't have anything to do with Casper. I'm not so much biased toward a company as I am biased toward good ideas, good opportunities. I like silver. Frankly, this will never happen again. But I like Charlotte. I like Cincinnati. Some of the opportunity zone advantages in those areas are incredible. And forget about the 10 years. It doesn't take 10 years to get your money back if they refinance because they're doing so well. 2, 3, 4 years in. In Cincinnati, I haven't heard the latest stats today, so pin Amy this afternoon on Cincinnati. But I believe he will get at least 80% of people's money back within 2 years. Tax-free.
It should be new ones with all the-
When Cincinnati came out, Amy's boss was upset with me. Because prior to that, my favorite had been Charlotte. But when I saw Cincinnati and met the guys who were converting that office building to housing in Cincinnati and knew what the tax advantages they were being given, they have so many tax credits for the conversion of that property in Cincinnati that you have a gain. You have a negative basis because he got so much money, it was more than his basis for doing the conversion in Cincinnati. Because Ohio, Florida, California, even states like Minnesota are desperate for housing. But Governor Weirdo is not one who will take good advantage of that. So I'm not real enthusiastic about Minneapolis, although I have a lot of good friends in Minneapolis. just simply because they're not taking advantage. Okay, Jam, let's go to the next slide. Previously depreciated real estate. There's a 25% tax, up to 25% on recaptured depreciation. Why do I say up to? If your total income is less, you won't pay 25%, will you? It's only if your income is at least what the unrecaptured depreciation is that you pay 25% on the unrecaptured depreciation. So, therefore, again, states tax capital gains. Many tax is ordinary income, but a few have special rates. I have no knowledge of this, so that statement there I hope is right, Ben. Cryptocurrency gains are taxed differently. You're going to talk about that, right? Yes.
We talk about state.
Yeah. And now I have to tell you a secret. It was almost embarrassing to me. When I left the University of Georgia in 1985, I hired one of my favorite graduate students to do some tax research for me. Why did I do it? Because I had a problem. My grandmother was in a nursing home, but my grandmother was of sound mind. She just was frail physically. And my dad was one of his children. And my grandmother was absolutely dogmatic. She didn't want her house sold. So now she had been in that nursing home for 2 years and 10 months. What problem were we about to have? We're going to lose the personal residence rules, right? But my grandmother didn't want to sell. So I said, Lucy, and I haven't had any contact with Lucy in probably 30 years, so I don't know if she's still living even. But I asked Lucy to do some research for me. I said, I want to know what the related party rules are on capital gains. I know what they are on losses. I want to know what the related party rules are on capital gains. And what do you think Lucy discovered? There aren't any. I'm sorry I yelled that at you. That's important that you realize that. So, here's what we figured out. My grandmother could sell her house to her 6 children. As long as it was at a gain, there was going to be no tax because of the personal residence rules. It wasn't a real expensive house. But not only was there not going to be any tax, we also figured out if they do it on an installment basis, Bobby, they don't have to pay her anything because they were paying her bills at the nursing home. So she could just simply do what? Forgive the loan each year. It is critical that you understand that there is no such thing. In most cases, there are few. In most cases, there are no rules on related party gains. The rules were designed to prevent abuse of related party losses. So oh boy, I'm looking around. I don't think anybody's an attorney. Oh, well, you don't count, Ben. He's an attorney for tax court. technically. Attorneys are fond, have been fond over the years, sell properties within families for $1. I don't. I have once or twice done something like this, but I don't typically yell idiot at attorneys. But that's a very foolish practice, isn't it? Because it involves the related party loss rules. And what we want to use is not related party loss rules, but related party gain rules. And they don't require payment of any cash. I don't understand. I just don't understand. Unfortunately, if they have to take a tax course in their law school training, it's probably only one. And it's probably not real good. So remember, there are no related party loss rules. Yeah, get the screen back up, please, Jeb. So there are wash sale rules. Likewise, there are wash sale rules on tax losses, but not on tax gains. So I have a situation right now where I have a stock that I know I've been following for 30 years that deals with self-storage. You all know that self-storage is far and away my number one category. And it's because it's a license to print money. And it's getting worse because what's happened post-COVID? Post-COVID, people are using storage rather than offices, aren't they? When I had an office, not the current office that I just gave up, but the one I had previously, it cost me $450 per office. So to use an office for storage cost me $450. To use a storage unit cost me $125, a mile away. That didn't make a whole lot of sense. I'm not real good about being frugal, but I'm not totally stupid. So I learned that I don't use an office for storage when I could use a storage unit. And post-COVID, storage units didn't get hurt by COVID. They got what? They got helped. Office buildings got killed. Storage got helped. Well, I had some storage that I'd owned for 30 years that went public in April with a 6-month lockup period, which ended October 1st. And I knew right after October 1st, there were going to be people wanting to sell it. Why? Because first they had liquidity. So, sure enough, as expected, when October 1st hit, stock price went down. But I had gains in it. Is there anything to prevent me from selling it at a gain and buying it back 2 weeks later? Take my gain and then 2 weeks later get in it at a lower price? No. There are no wash sale rules on gains. Wash sale rules apply only to losses. We get what I'm going to call frozen brain syndrome. We think that related party rules, wash sale rules apply to both gains and losses. Neither one applies to both gains and losses. They apply only to losses. And that's very important. Let's move on, Jam. Deferred taxes. Now, a lot of people are opposed to opportunities, using opportunity zones, because they say, Rick, that only postpones payment of taxes. As is so often the case, they are wrong, wrong, wrong. First place, is deferral of taxes a good idea? Yeah, absolutely. You gain a lot by deferring taxes. Secondly, might deferring taxes be combined with some of these other things to not only defer taxes, but to eliminate taxes? And now I come to, Jan, will it hurt if I sit for a second? Oh, yeah. Thank you. Yeah. This is a classic example of using tax planning to combine deferral of taxes to avoid with avoidance of taxes. Let's take, Rick, that person with 40,000 of ordinary consulting income, or they're a semi-retired real estate person to do one or two sales. 40,000 of ordinary income, 40,000 of Social Security, and 20,000 of capital gain. And there's probably going to, they're 55 or 60 or even 65 and going to work a while. And, or 70 like me, going to work a while. What's to prevent them from doing a retirement contribution? Defer taxes, get the ordinary income portion of that out, and now pay no tax on Social Security and no tax on capital gain. Now, I probably need multiple strategies in my 40-40-20 example. Maybe they need to do 30,000 of retirement, eliminate most or not all of the capital gain, so that they wind up deferring taxes, but also avoiding taxes. That's what I'm like, a little kid in a candy jar, with a candy jar. With a candy jar is good enough. Because my parents don't know I got it. Thinking about what I could do in January through April and show you how to combine these 5 or 6 things to both defer taxes, but more importantly, what? Avoid taxes. The opportunity's never been greater, I don't think. Ben, you think with me. I don't think the opportunity's ever been greater because of what they just did. We've had the zero capital gain rate, and they retained that. We had the Social Security taxation. They've taken a lot of that away.
QCD.
We got QCD. Yeah, and the charitable donations. I'm going to show you some really sexy stuff with charitable donations in a little while. The opportunities have never been greater. And it's exciting. Reverse mortgages. Boy, some of the great minds in the country are now finding plans to use reverse mortgages. Now, sometimes you have to be both a scientist or mathematician and a diplomat. Who's not going to like reverse mortgages? children. What do they think is happening? They think the parents are spending their inheritance. Sometimes I have to show them that not only are the parents spending their inheritance, that they might be increasing their inheritance by using the reverse mortgage technique. If parents don't pay taxes because they use reverse mortgages for their cash flow, that's building the family assets as opposed to reducing the family assets. And in case you think, oh, but there's interest on reverse mortgages, unfortunately, I can't be here Friday afternoon. So, Ben, I would ask you to ask a few questions about the interest rates structure on reverse mortgages. It's very limited what they can charge. I don't mind accusing the guilty. The number one, and I'm not going to tell you who it was, the number one reverse mortgage lender in the state of Georgia 25 years ago is no longer in the business. Why? Because they didn't like the rules that Jack Kemp wrote. Jack Kemp was worried about baby boomers. He thought baby boomers were very irresponsible in terms of our savings. And he didn't want the government to have to pay for us. But he thought, where is the one place, Vic, that baby boomer or Karen or Robin, where's the one place baby boomers are building wealth? In their residence. And they're lucky enough that real estate is appreciated. The little house, many years ago, the little house my parents built for $5,000 in Little Chapman, Nebraska, was sold for a lot of money. A lot of money in those days. Now, it wasn't 200,000 or anything like that. But if you build it for 5 and sell it for 90, that's paid proportionately. And so a lot of people have a lot of real estate wealth. We have people complaining right now that there's not enough real estate inflation, that people's values of their homes aren't going up fast enough. And it's going to kill the baby boomers and Gen X's, etc. They're wrong. At least the smart ones, because you don't have to sell the residence a lot of times to get some cash out of it. You could do what? Take out a reverse mortgage. The interest rates are limited that they can charge a reverse mortgage. There's a federal statute. And you're not going to believe this. That federal approach with the federal reverse mortgages gives you an increased credit limit every year. So it's protection against what? It's protection against falling housing values. But it's even more important, and this might startle you. There may be some of you who have long-term care policies. I used to recommend them to everybody. I haven't recommended a long-term care policy in 15 years, Alan, because I recommend reverse mortgages instead. They're a better way to solve the problem. If your housing credit is going to go up 6 or 7 or 8% a year, and you could use that, you could access that through a reverse mortgage, why do you need long-term care policies? that same relative that I was talking about, who was housing poor, has been living off reverse mortgage loan for the last 3 years. Because the health of the senior member of the family he's been on deathbed for 5 years, let's put it that way. Not been able to earn anything. But he's just 6 months older than I am. And he has needed to. Their house has gone up more in value than they've taken out via the loans. So let's examine reverse mortgages versus long-term care. Long-term care, we don't know what medical costs are going to do. So the companies may have to increase the premiums like they do health insurance. Secondly, the health insurance doesn't add any value. The house does. And if you want to challenge me on the house does, you have to remember that the reverse mortgage rules have a built-in credit. Why do I admire my friend Dan Holquist as much as I do? Because nobody knows reverse mortgages like Dan Holquist does. Big real estate firms, big banks, big insurance groups pay Dan a lot of money to get his insights. He sells a lot of books every year. He does a lot of lectures every year. We have a special treat. Now, unfortunately, as it works out, I'm only giving you an hour of Dan on Friday. You're probably going to be unhappy with me because I only gave you an hour. Here's the good news. Dan will be back in webinars early in the year on reverse mortgages. I know some of you were probably there. I think, Karen, you were probably there. Ben, I know, was there. Kelly was there. The first time I gave Dan an hour at Gwinnett, no, he took the afternoon. Well, the audience loved him so much I couldn't stop him. I mean, so I gave him from 1 to 2. He took from 1 to 4:30. And when he finished at 4:30, he couldn't get out of there because people were lined up to ask him questions. So, not tooting either Ben or I's horn, other than we're smart enough to be Ronald Reagan or Bill Clinton or John Kennedy. And no, Dan knows more about reverse mortgages than anybody we know. And let Dan have time with you. It will be well worth your while. What's the time?
Yeah, about 10 minutes.
10 minutes.
Or when lunch actually is done.
It's not set up quite yet. All right, so let's go to the next slide. Loans. The one big, beautiful tax planning advantage is that loans are not taxable. So if I need access to my funds, but I don't want to sell my funds, one way to get access is through a loan. Oops. A reverse mortgage loan, an opportunity zone refinancing. Anything wants me to want to scream. And you know that I get emotional enough and such a pathologically oriented person that when I think things are wrong, I want to tell people they're wrong. I don't understand the lack of understanding of opportunity zone. It's especially short-term gains, but even long-term gains. To defer $1 million capital gain, and 2 years later get 60% of it back in a loan, a refinancing? Why is that not giving you liquidity? And why is that not a better deal than paying the tax on the $1 million gain? I don't understand it. And I think it's the same reason. And now you're going to listen to me, because if you don't, you're going to, if you have something that's worth $4 and it's no longer worth $4, you have to sell it to Ben for $2. The $2 you get, what kind of return do you have to have on it to get back to $4? You have to get 100% return, not the 50% you lost. So, mathematical way to say this. I get accused of being a math nerd. Just this last Friday night, I was at a meeting with a group of neighbors. We were having a Halloween party. And I ran into a person from my old church. We were talking, and we were talking. They owed their pastors over $100 million in pension. And I was the member of the board who had to help figure out how to get out of that problem. So I put together a plan. I think it was a sound plan. And one of the preachers who had a little bit of business back challenged me on it. I didn't quite know how to respond. I felt like I was the college professor and he was the third grader trying to challenge me on it. And I didn't know how to explain it even to him, Bobby, where he was going wrong. He thought we were robbing benefits from people. No, we were just doing things in a smarter way. Sometimes perspiration wins the case. Sometimes inspiration wins the case. I don't know about you, but try this. If you have the bad habit I do of falling asleep thinking about business, I do my best thinking when I'm asleep. I have colleagues who say, let's let Roger get some sleep, because he gets his best ideas when he sleeps. And that's somewhat true. All right, so we have 2 more hours of this afternoon. Amy Kelly will be here to talk about some incredible opportunity zone investments, et cetera, for an hour. She brought a lot of material. Ben and I have, I think, over 100 slides. I think Amy brought 200 pages of material. So she's going to have a lot to talk about in an hour. But her group does have Cincinnati, which is still my absolute favorite opportunity zone. He will refinance, I predict, at least 80% in 2 years. He's brilliant, but he invested 18 million. I think he's up to 40 million in credits now from government. So that means he has a negative $22 million invested in that building. That's why I like that opportunity zone and the ability to refinance. And I think lunch is ready. Let's have lunch. This does tire me. I'm fine.
Testing, 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 testing. One, two, three. We are live, guys, in 3 minutes. 3 minutes. We will be live in 3 minutes.
Perfect. Welcome to the resumption of the RCF tax education. I'm going to show you something that as a tax professional, you have to be able to adjust to. The strange layering that we do. Remember, I grew up in Nebraska. So some of you, big city folks, probably don't even know what I just drew. I drew what it was very common in Nebraska. It's called a silo. And in taxes, what's important about that is that the bottom layer is ordinary income. There are other things in between here, but the top layer is capital gains. My grandfather on my mother's side was a farmer, and he had silos. And by today's tokens, you wouldn't believe it. He let we kids play in a silo. Now we've now we heard about have heard all the stories about people dropping 20 feet to their death in a silo and losing all the air. But
Learned how to swim on corn, right?
well, not it was corn or wheat. No, we were on top of it. But playing on that is something that nobody would be allowed to do today. But Grandpa didn't think of it. And fortunately, we none of us suffered anything from it. But here's what's so important to understand in terms of tax planning. Capital gains are taxed on top of ordinary income. What that means is that when we talk about the capital gains rates, 0, 15, or 20, it depends on how much ordinary income there is. And if you eliminate capital gains, your savings is capital gains. If you eliminate ordinary income, your savings is ordinary income. So this is the highest rate. This is the lowest rate. And when we talk about income going in, we talk about capital gains being on top of ordinary income. Now, this is the Ripley's, believe it or not. Because the tax law generally is not designed to be in favor of the taxpayer. Did I say that?
Really? It's a surprise.
I mean, that's a terrible thing for me to say. But no, it's true. But here's the funny thing. In the brand new tax bill, we have an enhanced, and Ben will do the talking about this. We have an enhanced standard deduction. What limits, Ben? The enhanced standard deduction, because it's pretty significant. What are the levels? The enhanced.
Enhanced standard deduction. Okay, well, you're going to have, first of all, you're going to have your tip income gets into your standard deduction up to 12.5, and then you got your overtime. Now, let me make sure I got that right. One of them's 25, one of them's 12.5.
I'm not putting you to the test there.
The overtime is 25,000. So that's going to be an additional.
And they raised the standard deduction, didn't they?
They did, yeah, substantially. But of course, you have to remember, in 2025, we also have an increase in this. So for your high income taxpayers, or those that live in a state that pay high state tax, those folks can go all the way to $40,000 this year. There's going to be a lot of people that have been out of the itemizing game for a long time that are coming back in this year.
Well, the income limits for usually the people who live in.
And in addition to that, and without insulting any of you, most in this room qualify, we have a new senior deduction.
Now, all three of these things that we just talked about, including the senior deduction, have an income threshold
Yes.
that we have.
Where they start phasing out.
Yep.
Yeah.
It's either 150 or 300,000, depending on which type of deduction.
So my opening remarks this morning about AI being applied to taxes. Wouldn't it be nice if we could build an AI model and Karen or Brad or Rick could say, this is a client, I want their variables put into an AI to figure out an optimal way to reduce their tax liability.
Roger, you realize.
Right now, the optimal model is not very optimal. It's me.
Roger, you realize you just came up with an idea that could be a multi-million-dollar venture for somebody that had the technical background and that could feed in what we have as CPAs and accountants, come up with the ultimate or best result.
I'm going to convince somebody to do that, Ben.
Well, somebody's going to make a lot of money on that idea because they'll sell to all of us, and we'll be glad to buy the AI program to have that.
I think it's going to happen in the next 2 or 3 years.
The question is, who's going to step up and build?
The problem, as always, with software programs is going to be garbage in, garbage out. If you don't have people who have a good, thorough knowledge of the subject matter, the AI model is going to be worthless. But it'll happen because the great new tax bill creates so many opportunities along that line with all of these factors. Now, a couple things I want to point out to you. Remember, this is on top of both the standard deduction and the itemized deductions. We don't see that very often, do we? That kind of thing. So that makes it way more useful that it's used with itemized deductions, and it can be used with standard deductions. So many. Those webinars that I'm going to do in January through April, where I do the 20 examples of just common people and how they can save $10,000, $20,000 in taxes, they're going to be a lot of people with that modest 40,000 of ordinary income, 40,000 of Social Security, and 20,000 of capital gains type stuff. But we're going to have to use all of our tricks. We want to do away with the capital gain. We can do an opportunity zone. If they don't have an accredited investor status, we'll use a charitable trust, because you don't have to be an accredited investor with a charitable tool.
You throw quickly what accredited investor is? You want me to help?
Yeah, sure.
Okay. Accredited investor for a married couple, you have to have at least $300,000 in AGI to be an accredited investor. For a single person, it has to be at least 200,000 in AGI. But you can offset either one of those requirements if you hold up to $1 million in net worth, including the equity in your home. Why they exclude your home?
Oh, he's going to put a wire on you. So
Am I not being picked up? Now I am. Okay, do I need to repeat that? Okay, so here we go again. All right, accredited investors have $300,000 a year, for at least an average of $300,000 a year for the last 2 years, to qualify as a married filing joint. If you're single, head of household, you have to have at least $200,000 in AGI to qualify. That's an average over the last 2 years. If you don't have either one of those conditions satisfied, if you have at least $1 million in net worth is the difference between your liabilities and your assets, not including the value or equity in your home, then you can offset income requirement for the year. That's what an accredited investor is. And a lot of investment firms cannot get you the breaks that you need or help you with some of the retirement plans or investment plans if you're not an accredited investor.
and I'm going to tell you, that's why we have some of the experts on top of Ben and I talking. Dan Holtquist is far and away the country's top expert on reverse mortgage. Dan and I have been working on some stuff where, because we both have a strong Christian influence in our lives. And Dan, don't try to quote biblical verse with Dan. I promise you that. I thought I was pretty good. And the thing about, now I'm having a senior moment.
Which direction you headed in, Roger? Maybe.
Boy, I'll get it in a minute. I'll come back to it. Well, no, it deals with the Chinese proverb that it turns out everybody thought it was from the Bible.
May you live in interesting times. No.
Yes, that's it.
May you live in interesting times.
May you live in interesting times. Everybody thought that was biblical.
Proverb. Yeah.
It's not biblical. It's a Chinese proverb. And I made this mistake of referring to it as biblical.
Well, I bet you Dan shut you down quickly.
Dan shut in a heartbeat.
Yep.
So,
and don't use the other proverb, God helps those who help themselves. That's not in the Bible either. That was actually written by Benjamin Franklin and put into Poor Richard's Almanac.
I did not know that.
Yep.
Now, see what you might learn in
You
my
just never know.
Benedict
Dan and I could have fun. Yeah, you and me and Dan need to get together again.
But what I've learned a lot about this year, and one of the last couple of things I'm going to show you about tax planning is the use of charitable lead trusts. If you have somebody who's not an accredited investor, but you need to take advantage of some of these techniques, they can do it through a charity, because the charity is the accredited investor. The individual does not have to be. So, Boo, if you got a person with $100,000 worth of income who wants to reduce that income and wants to give some to charity, it may well be right for them to give something to charity and then replace the cash flow with a reverse mortgage. And boy, can Dan do some cool stuff in that direction. He's great at modeling. And I was not aware of that until this year. I hadn't thought about a charitable lead trust. I'd always thought about charitable remainder trusts where people were wanting income. But great new tax bill 2025 creates an incredible opportunity, an incredible incentive to do charitable lead trusts. Let me tell you why. Because this is leading into the next few slides anyhow. With a charitable lead trust, if you buy an asset, Vic, that is a depreciable asset, what did they bring back in the great new tax bill? 100% first year depreciation. If I now lease that to Ben, and he pays me 10% a year for the first 5 or 6 years, I could give away 2 years, 3 years, 4 years, whatever I want to a charity and get a front-end deduction. Oh my gosh. How powerful is that? When you combine it with no tax on Social Security, no tax on capital gains. And that's the point of this first 6 hours, is to show you 6 techniques. And then from January through April, I'm going to show you how to use them. But we're limited by Roger's cognitive ability. What if we could use the principles, get them into a good AI model, and let an AI model help us figure out how to combine them? Because I think I will have your mind spinning in January and April when I show you how to combine these and how a little dab of this and a little dab and so on is going to reduce taxes. That's my promise, that I'll take common people with common examples and show you how to save them $10,000 and $20,000 a year in taxes. And by the way, you paid whatever you paid to come into this seminar, you can save it yourself by using some of these techniques. Okay, next slide, please. Okay, reverse mortgages. Well, gee, the genius of Susan, who for 10 years represented 5 different full-time speakers and runs the World Clogging Association. She's beyond good on PowerPoints. So she always comes up with some interesting little pictures. So she's got that little picture at the top for reverse mortgages. What is critical in terms of what I talked about this morning, for you to remember about a reverse mortgage. It's not taxable income because it's what? It's a loan. And a loan is never taxable. Now, what I really like about a reverse mortgage, probably, I have to be careful, but I'll do this. I'll take a little family situation. I had members of my family a few years ago who had nothing but a very, very valuable house in Dunwoody. Well, there are a few very, very valuables in Dunwoody, but they didn't have anything to live on other than their Social Securities. They got a reverse mortgage, have been living on it for 3 or 4 or 5 years, and now the husband's going to die. Family members are coming to town the next 2 weeks to say their goodbyes to him because we know he can't live much longer. And are they ever going to pay tax on the money they took out for the reverse mortgage? No. Why not? Because they're going to get stepped up basis. They're going to get the personal residence rules, etc. They're never going to pay taxes on it. So next time you scoff at a reverse mortgage, I'm going to pull a Charlie Clerk on you. You better be ready to sit with a Dan Holtquist or a Roger Roemmich or a Ben Tallman and be able to defend your I don't like reverse mortgages position. Because there was a lot wrong 20 years ago with reverse mortgages. But, ooh, boy, am I wrong. 20 years ago. I need to go back 30 or 40. I'm wrong about the time frame. Who's the superhero in the reverse mortgage area? Jack Kemp. As I said this morning, Jack Kemp was not just a super talented football player, or as the women say, a very handsome man. Jack Kemp was one of the smartest men that ever was a part of the U.S. government. IQ way over 180. That's a smart man. And Jack Kemp, Ronald Reagan's genius was that Jack Kemp ran against, in 1980, in the preliminaries, against Reagan. Of course, Reagan beat him. Reagan was smart enough to know he wasn't half as smart as Jack Kemp. So he made Jack Kemp Secretary of the Interior at the time. And Jack Kemp, you might be right, it was maybe housing. Oh, that's right. I said interior, I meant urban development. Yeah. And the big thing that Jack Kemp did in the time he was Secretary of Housing and Urban Development was developed a model that made reverse mortgages very practical. They weren't practical before that.
Now, Ben Carson helped to implement those ideas.
Well, Ben Carson, and there's a story relating to Dan Holtquist with Ben Carson, too. Dan Holtquist was on Ben Carson's advisory council for a while. You're really privileged to have an hour with Dan Friday. Now, remember, it's the last hour. You might get lucky. The last time I had Dan Holtquist, they wouldn't let him out of the room. And people like Kelly remember, I gave him an hour from 1 to 2. We were to end at 4:30. He took all afternoon.
His energy. And he loves what he does. So
And when he got done,
and then
he had a line.
he signed all of those.
Well, he's Mr. Reverse Mortgage of the country. Nice guy. extraordinary personal characteristics, but he has a hard time understanding people's dislike of reverse mortgages. Sometimes you're too smart.
I'm having more seniors use it to pay for their.
Well, as I said right before lunch, to me, don't buy long-term care insurance anymore. Use a reverse mortgage. It's a much better way to do it. But let's think about, whoops, screen, please. They can be used to manage cash flows. And this is what I like so much with the great new tax bill of 2025. I can keep the cash flow I need. At the same time, I reduce the taxable income so that I don't pay tax on Social Security. I don't pay tax on capital gains, but I can have the cash flow through a reverse mortgage. And unlike the other two, a capital asset, if I hold it, it only works for me if it goes up in value. Do I have to worry about that with a reverse mortgage? Because there's a guaranteed increase. Guaranteed by whom? The U.S. government. So I figure if it goes bad, don't worry. There's no point in living in the United States anyhow. So is a reverse mortgage safer than a capital asset? Absolutely. Is it safer than a house? Yeah. The house may or may not go up in value so much per year. The reverse mortgage credit does go up by so much per year. So don't underestimate the importance of Dan Holquist on Friday. You've got the country's best expert for an hour, or if you can keep him here longer. Oh, that's right. He's not here. But he'll be on the simulcast. Jim, you might get stuck for a little bit because they don't like to let Dan go when they get him. Ben can testify to that. All right. Now, another loan situation. How about opportunity loan refinancing? I hear so often, and I get mad when I hear this. Well, I don't want to do an opportunity zone because it ties my money up for 10 years. Only if what? Only if the sponsor can't refinance. Well, I wouldn't say year two. You can ask Amy that question, but I wouldn't say year two. I'd say year 3 or 4, maybe even 5. But that depends on how good they are. Amy knows that the one I particularly love is Cincinnati, where he's got that huge negative basis because he's got more government credits by far than he paid for the building. That gives me a lot of comfort, quite frankly, that he'll be able to refinance. All right, so the loans through refinancing in an opportunity zone can provide cash flows during the required 10-year hold. Now, this morning, what did I say? What's the best capital gain to put into an opportunity zone? Short term. Second best, collectibles, yes. Oh, you're a good audience. Absolutely. Next. Recaptured. Well, recaptured depreciation's funky. When you have a capital gain initially, if you go into an opportunity zone, you do not eliminate the tax on the recapture. What you eliminate is the tax on depreciation taken during the term of the opportunity zone. You think we might need artificial intelligence for, for all this stuff? Because today you're limited to people like me. And next year able to recognize you. Who knows?
We'll bring you in the wheelchair.
It doesn't help if my brain's gone. All right, next. Okay. This is category 4. I've taken all this time on categories 1, 2, and 3. Most of you know, however, the way I build on things, that's not surprising. I got 3 more categories to go over, but they'll go pretty fast now because they're building on the ones we've already done. So category 4 is retirement contribution. And I have my note that I believe individual defined benefit plans are one of the most underutilized planning tools. Huh?
You don't hear it banded about.
No, you don't. People, yeah, the question is, why don't people hear about individual defined benefit plans? Because we had a funeral, pseudo funeral, 15 years ago, and everybody declared defined benefit plans dead. That's a mistake. What they should have done is say defined benefit plans in corporate America are dead. They should never have said, Alan, defined benefit plans are dead for individuals. Because for individuals, I'll give you an example. I can't tell you where in the country this is. I have 2 gentlemen who are friends selling his business to the other group. And the seller doesn't want to pay a lot of taxes. The seller's got a couple $1 million in a retirement plan. And the seller's retirement plan, a large of it's Roth IRA. Perfect. So he's going to live off the Roth IRA. He's also got a nice personal residence. He can live off the Roth IRA and the reverse mortgage, pay no tax, and use a defined benefit plan to offset what he's getting from the buyer. And by the way, would the buyer prefer to buy an asset or have a good portion of it be income to the seller? Most of the time, they prefer it be income to the seller. Why? The deduction's better, by far. But the seller normally doesn't like that. So what I've run into with a lot of attorneys, sorry, Amy, to be yelling in here.
You're good.
What sellers, attorneys don't like because they're not tax savvy, is they don't like their seller to get a lot of income. They'd prefer their seller get capital gains because it's a lower rate. Well, here's a problem. The buyer would prefer to do what? To have a larger deduction. Let's have our need it too. Let's let the buyer get larger deductions, and therefore might they be willing to pay more? Yeah. And then let's turn around for the seller and have it be on an even income stream for a while, and let them put it into a defined benefit plan, boo, and live off their other reverse mortgage or Roth assets. To me, that's a win. It's a huge win for all parties. And that's what I'm going to do with these two gentlemen who are negotiating a sale of that business. Well, there are not a lot of high powered tax planning strategists in the country. I don't know how many there are. There are some, but there are not a lot. And I will tell you that the big accounting firms want to claim they have the corner on that expertise. That's gotten me in trouble more than once. A few years ago, I went to the national AICPA meetings. And the next week, they were having the financial planning meetings. One was in Philadelphia, the next one was at Washington, D.C. So I was speaking in Philadelphia, the first one, on Social Security. And the people from the AICPA said, "Why are you not going to Washington next week?" I said, "Because I'm not a good deadpan." And what did they say? What did they mean by that? And I said, "You don't want me in there watching that person from a high-powered CPA firm give his presentation. Because if he says something that's wrong, my face is going to show it." They begged me to go. This was like a Thursday or Friday in Philadelphia. Monday and Tuesday was in Washington, D.C. So I went. And I took my notes and everything into the meeting. And the speaker said, everybody should draw Social Security the first minute you can. I might concede that might be right for a single person. But if they're married and they are the primary earner, that is not only wrong, it's dead wrong. Because Social Security then becomes, the rules are, the survivor of the member of the couple gets the better of their own benefits or the deceased benefits. So the higher earner should always try to maximize their earnings. So the higher earners, I almost always encourage to go to maximum age, 70. Now, the funky thing is, for lower earners, it's exact reverse, isn't it? Because if only one of them is still living, the one who's still living is always getting the higher's benefits. So when the speaker got up there and said, everybody should draw at the earliest possible moment, it had all sorts of graphs and everything, I gathered my materials and I walked out the back door. And the person from the AICPA who had sponsored me the week before and who had encouraged me to come said, "What's wrong?" And I said, "You just had a high-powered partner in one of the big accounting firms in the country make an absolute fool of themselves in terms of what they said, because they didn't understand the powerful incentives for married couples for survivor benefits. During the Obama administration, we used to have a rule that would let you have your cake and eat it too. You could draw your own benefits and with your spouse's benefits, then you could switch over. And if that was a good strategy. They closed that loop in the Obama administration. What they didn't close, what they didn't do was eliminate survivor benefits. So can you get survivor benefits and then at some point switch to your own? So think about what that means for strategy. That means that you could draw your own and collect survivor benefits if your spouse is already dead. Or you can let your own grow while you collect survivor benefits. That's probably the better strategy. This is where I see the future for AI. We have to capture, and Ben, I don't know if you agree with me, I think there are fewer and fewer people who really understand a lot of the strategies, understand all these interactions. It won't matter, Bobby, if we can do what? We can capture it while they're still alive and can help with the programming, capture it in AI. But if we don't capture it in AI, my friend who, and I will give her, I'll say her name because she's retired. My friend Cindy Lundquist, who lives here in Atlanta, Cindy Lundquist is close to being the Dan Holtquist of Social Security. But what I call Cindy these days, it's almost like, don't bother me, Roger. I'm retired. Which is a huge loss to the industry. She used to do all the government training on Social Security. Like other agencies of the federal government would take no one other than Cindy to do their training. And what happened in January that I told you about this morning? President Biden, not Trump, Biden, on January 5th, which I believe was either the day that Congress was seated or the day before. President Biden signed, this is bizarre, the Social Security Act of 2023. Mind you, this was in January of 2025, but he signed the Social Security Act of 2023. And the Social Security rules moved, believe it or not, or you can only go back 6 months. And there's been no mass education of the public. There has been no provision in the government for the fact that already people had lost some of those benefits because they should have started January 1, 2024. It wasn't signed until January of 2025. So going back 6 months didn't capture all of that. And what Cindy is doing now is she's working for the state of Georgia to try to educate teachers because we have so many counties that have opted out of Social Security. Now, we have some bizarre rules. Good financial planning is not what people want to do. I have a friend, I won't name her because this is really bad situation. I have a friend who worked in Gwinnett County. She was really high powered. She's the one I told how to retire at 54 rather than having to wait at 60 something and get full retirement benefits. She was married for 18 years, I think. And about a year ago, her ex-husband passed. Now, she's still only 56 years old. There's a peculiar rule in Social Security. If you remarry after 60, you don't lose survivor benefits from the first husband. If you remarry before 60, you do. So I told her I had two. One who worked for me. Ladies, at Cindy's suggestion, get a divorce when they had remarried too soon for a short period of time so that they could then get married again after 60 and draw survivor benefits on the first husband. It sounds silly, doesn't it? It was $5,000 a month in one case. But my friend told me, I've been waiting to marry this man for 30 years. I'm not going to risk anything by getting a divorce. I said, not even for $4,000 a month, he might understand. You can get remarried, but you got to be divorced for 30 days or so. But my friend was not terribly impressed with the information I gave her. But boy, I knew it was $4,500 a month.
Well, you can do an amicable divorce without an attorney. So that wouldn't have cost them anything just to find.
Well, it wasn't the cost. It was the psychological. It was the principle. That is a high price principle. But those are the kind of things we're going to need AI for.
When did they take out that you couldn't repay your social security? Remember, you used to.
2013.
Okay, because you could.
You used
turn
to,
it on and then you could pay it
well,
back with no interest.
you could still repay it, but it's got to be with, and I don't remember the period. It's either 6 months or a year.
If you started.
If you start it, you can repay it in a very short interval.
I don't know.
I could look it up on my cell phone. While Amy's talking, I'll try to look it up. But it's a very short interval now. You used to be able to do it for much longer. All of that happened around 2013.
Because you didn't even have to pay interest for
Yeah.
everything on the money that you'd received for a couple of years.
And while I'm telling secrets on myself, in the mid 2015 type framework, I knew Social Security frontward and backward. But I had too many other things I was doing. And so I didn't spend much time looking at Social Security. I didn't have to until now. Because when I would ask Cindy, she'd say, nothing's changed. Nothing's changed. Until what? Till 2025 with the Biden thing. The Biden thing affects a lot of your clients in Metro Atlanta. Why do I say it does in Metro Atlanta? Because so many of our school systems opted out of Social Security for a while and therefore had reduced Social Security benefits. They couldn't even get, remember, full survivor benefits if they personally did not pay into Social Security. What Biden signed, ironically, titled the Social Security Act of 2023, January of 2025, what Biden signed eliminated that penalty. There was also a penalty for having a government pension. Did you wind up with the government pension?
I did. I got both.
So
Social Security.
if you had died, thank goodness you didn't, Barb would not have gotten as much of your Social Security because you had a government pension.
Except I hit the exception. I have more than 35 years paid into Social Security.
Oh, well, yeah,
That excludes that limitation.
yeah, you have to have
I can
25 or so.
I can max out Social Security, and now I retired at 53 from the government, so I had a small pension.
That means you're old as dirt.
You're right.
You started when you were like 5.
I started when I was 5.
Yeah.
It was that new government kindergarten program, you know.
I, He's younger than I am, so I can tease him.
Only a
But
couple of
retired from
years.
the government
Yeah.
for 35 years at 53. That's impressive.
I was working other jobs under Social Security while I was working for the government. You have to understand, I've been doing tax returns since 1977. That was the year after I left the IRS.
I didn't know you were
And-
there.
Yeah, I was an examiner for the IRS.
Why'd
Auditor
you
for the-
quit?
Huh?
Why'd you quit?
I just moved agencies. I couldn't continue to do what I was doing and live with myself. Just real quickly, may I?
Sure.
Okay.
He needs a mic again.
No, yeah, do I need that? Sure. Oh, that's all right. I mean, I want sharing. I can just hold it, can. You're gonna put it on my pocket, aren't you? Okay, thank you. All right. I was doing an audit on a single mother that brought in 2 children with her, 5-year-old boy and a little one she was holding. And back then, at that time, the father had deducted both of the children because he made the higher income, and I had to make a $6,000 adjustment on her for that year. And I remember she just put her head down on my desk and started sobbing. And her little 5-year-old said, "Mommy, Mommy, what's the matter?" And I felt about that small, and I said, "What are you doing with your life?" I mean, I put 2 years in the military, and then 2 years with the IRS, and I realized once you work for the government, you can change agencies like most people change departments. And I just found out that VA was hiring mortgage underwriters. Called up, had an interview on Monday. They offered me the job. They said, "We'll just transfer all your paperwork over from IRS." And all of a sudden, I had all my friends in the softball league and everything else that said, "Well, now can you do our taxes?" And I had 30 people the first year, which by the time I retired had grown to 600. So that's why I've been paying Social Security for 35 years. So,
Okay. So we're just trying to, all these stories have the
yeah, at the
intent
IRS. Yeah.
of showing you that my 6 techniques that I'm showing you today can be used together to reduce that. Now, the final point I want to make here on this diagram is that capital gains are taxed on top. So it might make sense if you understand the silo principle. It might make sense.
You're blocking your screen from the camera.
Oh,
That's all right. I just want to let you know.
it might make sense that if income's on the top, when you have deductions, they come off the top. But the way I'm saying this, that's wrong. That's wrong.
Mm-hmm.
A standard deduction an itemized deduction comes off the bottom first. Is that important to know?
Of course.
Oh, of course. Why is it more important to know in 2025 than any year previous? Because that's how Social Security gets taxed. So we want to take it off the bottom. Because not only does it take it off ordinary income, it reduces the probability that Social Security gets taxed. And ultimately, the probability that capital gains gets taxed. That's why it's going to take me 4 months and 20 examples to show you how to put these things together. Now, I may not be done in April because I'm trying to do that for the modest income people. People always say, You talk about the highest income people, not after the great tax bill of 2025. I'm going to be talking about people who make what you make or what your friends make, etc. What probably 80+% of your clients make. That's what we're going to do in my webinar. Now, the plan is each month for me to do a 2-hour webinar and Ben to do one. So he can tell you what he's going to do. That's what I'm going to do the first 4 months, is combine all of what I've done in this first 6 hours. Now, we haven't done a good job, but we're going to right now in explaining to you one of the beauties of having Jam here. And one of the beauties of this being on YouTube is anytime you want to go back and look at it, you can. And we've never had that opportunity before.
That's right.
When we went to simulcast this year, you could go back and look at it. And I hope you will.
Unlike Zoom.
Unlike Zoom. The ability to go back and look and say, I didn't quite understand that. Roger didn't present that as well as he could have. Or I was asleep when Roger presented that. I don't see any of that. I was pretty good. I'm not the kind that one of my professors was when I was at the University of Nebraska. One of my classmates fell asleep when I was in a management accounting class. The teacher turned around, saw he was asleep, took the eraser, and threw it at him. Slight problem. Didn't hit him, it hit me. I wasn't too pleased about that. I don't do things like that. This is an important principle, though. The income sum was off the bottom. Let's go to category 5, Jam. And I need to know how much time I have left, Ben.
You have 1 hour left.
Okay, perfect. Any of you thought, and people who've come to see me in the past probably didn't, that I couldn't fill 6 hours with this set of slides? You don't know how much hot air I have. All right, charitable strategies. You probably have seen less of this than any of my other topics from me in the past. I worked with a group this year, got really excited about what they were doing in the charitable trust area. Have to admit, I learned a lot, but then I learned, I don't know that I like their ethics. Now, does that put you in a bad situation? They taught me. But then I found out I didn't like their ethics. Because what they were doing is they had a charitable fund, which was beautiful in concept. It was great ideas. Then they had a servicing contract with a for-profit group that took all the profit. In the banking industry, they wouldn't let that happen. They would say that's a violation of the Chinese trust, the separation between the trust department and the investment groups or the banking groups. But this group didn't have that in charity. So, great charitable concept, but then all the profit was being made in a for-profit small group. They tried to present at the IRS forums at my suggestion. IRS denied them. I couldn't figure out why the IRS denied them till I found out what they're doing. For those of you who are online, it's time to put.
That's perfect.
Give me consistent direction. Yeah, I have some saying, some people saying down. Okay, that's enough. We won't you Jenny. Uh, I had been hearing about one of the new ideas I have this year. It's not new, but it has more power than it's had in a long time, which is charitable lead trust. So let me now go to the board and show you how charitable lead trusts work. And Amy and I need you to become a cheerleading section for us with her boss. Because we need somebody to do charitable lead trusts in an upfront, straightforward, ethical way. Because they got power as a result of the great new tax bill like they've never had before. All right, so here we go. Step one. Whoops, sorry. A little unstable there. One, buy a depreciable asset for use in business. And what's the depreciation rate in 2025? 100%. So you, yeah. Guess what January 20th is? That was the inauguration date. So we're going to take, I'm going to put them in boxes.
Bought it before.
If you didn't put it in service.
Service on the 20th or after, it'd probably be okay.
Right. So you take 100%. Gosh, if you're in the right state, including Georgia, you're up to almost a 50% write off, aren't you, for some people? Now, step two, lease it for cash flow. It really should be, but doesn't have to be, fixed cash flow. Now, what does that mean? It means you have what, an 8, 10, 12% cash flow, depending on the asset? So, step three is to give the cash flow to a charity. Does that have value to the charity? Yeah. So, what government allows you to do is you see the term charitable lead trust. What do you suppose lead means? You get to take the deduction, Ellen, for all the years of cash flow you're giving away. In what year? 1 year. So let's give away 5 years of 10%. Now, you don't get to take 50% because there's a discounted cash flow problem. But it's 2025, and these rules for discounted cash flow are pretty generous, roughly 4%. So, therefore, let's make this be worth 35 cents. $35 per dollar. What's your first year write off from the charitable lead trust? 135%. And this is almost unbelievable. At the end of the time period you gave to charity, you get to determine who gets it back. It could be your child. It could be your spouse. It pretty much could be anybody but you. Wow. That's pretty sexy. But now let's combine it with, what if this is used? Remember, I just drew you the diagram. Where does a deduction come off my silo? At the bottom, right? Ordinary income. So a charitable deduction or an itemized deduction comes off the bottom. So might I use a charitable lead trust to create no tax on Social Security, no tax on capital gain, and I bet you I can put together some examples where you get more than $1 back in year one for $1 spent. Well, think about it. You're already up to 150% or 135%, somewhere there, 135 to 150 range of the income to begin with. And then if it, because you did it, causes you not to pay tax on Social Security or not to pay tax on capital gains, that's a win. That's a win. And now I can hear people screaming, what am I going to live on, Roger? And Dan Holtquist will have an answer for you on that. We're going to do a reverse mortgage for our cash flow because a reverse mortgage doesn't produce what? Doesn't produce taxable income. We're putting these strategies together, but charitable strategies have been ignored forever. Now, I told you Dan Holtquist is brilliant. And he doesn't understand tax professionals thinking because he's so quick that he says, well, obviously every tax professional is going to love that. I say, no, Dan. 5% of them are going to love it. 95% of them don't even want to hear about it. And that causes Dan to just shake his head, frown. He would never utter a cuss word because Dan doesn't. But he just thinks we're dumb if we don't understand these concepts. And if Dan writes an article, he can get it published anywhere because of who he is. So Dan and I are going to try to do this. He's worried about the fact that we have so many people. Fortunately, my parents weren't in this situation. But one of the ladies who worked for me's parents was in that situation. Her father was dead. Her mother It's too charitable, Ellen. We have a lot of older people who are like that, don't we? They sacrifice their own living capability in order to continue to be charitable as they get older. Well, Dan and I have a solution for that. Take a small sum from a reverse mortgage, put it into a charitable lead trust, giving the charity income that you would have given them out of your cash flow, giving the charity income out of your cash flow. And your family ultimately gets the asset back. They just gave away the cash flow for a few years. But by using a reverse mortgage to do it, you didn't use any of your normal asset. You got a tax advantage, and you got a charity benefiting from your generosity. And Dan thinks the reverse mortgage industry's going to go nuts over that concept. I think charities are going to go nuts over that concept because when people get to be retired, they generally stop doing what? They stop being charitable. They must not watch the television I watch because the television I watch breaks my heart. I watch television where the primary advertisements are for the Danny Thomas. If that doesn't break your heart, small children at risk of dying of cancer. Now you're going to think I'm a horrible person when I say this. I have almost as much trouble when I see the commercials for neglected animals, the abused animals. There's another. So if I ever win the lottery, I will be one of the most generous people ever to win the lottery because these charities just break my heart. They just break my heart. And boy, am I glad for 2025 and what I can do with the Charitable Lead Trust. I've never, to this year, recommended a Charitable Lead Trust. And I probably should have 6, 7, 8 years ago when we had 100% depreciation. But that went away. But the great new tax bill brought back 100% depreciation. Now, did they bring it back permanently? I think it goes out 30. Not very long. But for the next 3 or 4 years, what an incredible tool, maybe 5 years, what an incredible tool charitable lead trusts are going to be. And absolutely wow. Okay, Jam, next slide. Okay, charitable remainder trust. I have to be careful with my stories. Unfortunately, I have a lot of practical experience with some of these stories that I can't tell them straight out. I had a very, very successful student at the University of Georgia who went to work for one of the big accounting firms, and he became the head of financial planning. We had a client in common. He is the representative nationally for one of the big accounting firms, and little old Roger. And he sat with them one week, and he told them how they could do 12% income off a charitable remainder trust for the life of that asset. I was there the next week, and they said, so and so told us we could do this last week. And I said, I can't believe that. He was a student of mine. He's brilliant. And he's head of financial planning for a national firm. Surely he didn't say that. Because a 12% income interest would have meant a 1% or less projected income or interest for the charity. And I said, well, that's what he said. The next day, I happened to be driving into Atlanta. I lived in Athens in those days. I happened to be driving into Atlanta, so I called him. And I said, and I have to be careful, I'm so apt to say his name. But I called him and I said, did you really say this? And he said, yeah. And I said, did you do the math? Do you know that that charitable interest is worth less than 1%? Within a year, IRS changed the rule. The rule is the charitable remainder interest to the charity has to be at least 10% projected. I call that, and I can't name the accounting firm, I call that the blank blank rule. Yes, Vic.
How did you get the Form 6227 to work out mathematically?
You had to.
It imposed on the.
It didn't impose the limitations in those days.
I've been using that for a dozen years.
Oh, my story's 20 years old. At least. It may be 25 years old. I'm telling it, Vic, so people understand. You have a minimum recommendation, minimum rule on how much has to go to charity. But the remainder can be paid as income each year to the donor. The donor gets a nice upfront deduction, but here's the catch. The donor's cash flow is based on the character of the asset they gave away. Yes, and it always has been. So if they give away an asset with ordinary income characteristics, guess what they get back? Ordinary income. Yeah, there are all kinds of tricks. When I was going to Hawaii 12 times a year many years ago, this was the major reason I was going there. Their trust departments were doing a lot of remainder trusts. And they got somebody blew the whistle and said, stop, we think you got a problem here. And fortunately, I got hired to consult them. What a terrible duty to have to go to Hawaii once a month. That's why it was tough duty. But it's a brutal flight. I did learn how to do it. I would go out in the daytime. When I get there, it might be 11 o'clock my time, but only 5 o'clock Hawaii time. I would immediately go to bed based on my time. Because if I didn't, I couldn't adjust quickly. And on the way back, I always took a red eye from Hawaii back here. If you ever go to Hawaii, I totally recommend you do a red eye. If you sleep on a plane. My ex-wife and a friend from Athens who was a high-powered agriculture professor happened to be on the same plane one time with me. I slept all the way back, and the two of them walked the aisles. They were in bad moods when they got back. I was happy as a clam. That's what you do Hawaii. But charitable remainder trusts do require the 10% residual. They have done that for now probably 20 or 25 years. But it wasn't always that way. When they were first popular, and I'm saying 20 or 25, it's probably 35 years ago. Because when I think about it, it was the 80s to 90s that I was going to Hawaii so much. Oh, it would have probably been roughly 1990 or 1992 or so when they changed that rule. So that, unfortunately, that would be 33 years ago. It's not bad getting old if you don't feel your age. I'm lucky enough I don't. And I think Ben's pretty much in the same category. But knock on wood, our life expectancies have gone down a little bit. All right, category 6 and final category. Oh, yeah, the last couple thing is the summary and conclusion. All right, move on, please. Summary and conclusion. A couple things to know about tax brackets. I put them up here so you will know. As before, in the Great Bill, new tax bill, the MFJ categories or rates are not exactly double the single rates. They are up to, and that's why I did it this way, and Susan is brilliant in her PowerPoints. Note that when you get to the 35% bracket, they're no longer double. So all the way up through the 32% bracket, they're double. But in 35 and 37, they didn't change the rates. They just changed the way they work. And it has been that way for a while. The 35 37% brackets are no longer double. But I would say to you, you should have less than 2 or 3% of your taxpayers in the 35 or 37% bracket anyhow. I'm going to plan them out of it. It's a good thing that I no longer do taxes and haven't for years. Because if I did, Reg, everybody I did taxes for would get audited. Why would everybody I did taxes for get audited? Because I would have Goldilocks levels that not AI, Roger I would say, I don't want you to pay taxes at a certain rate. So I'm going to plan you down to that rate. Go back with that chart, please. Jam, yeah. I can help you a lot. For single taxpayers, anybody want to guess what my maximum income, taxable income level is? Use it logically. It's 197,300. Why? Because up to 197,300, brackets don't jump a lot, do they? Look what happens between 197,300 and everything above that.
8% jump.
It's an 8% jump. Before that, they were 2 and 3% jumps. So I'd have a lot of tax returns for high income people that were 197.3 if they were single, or double 197.3, which is 394.6 if they were married. And I would really try hard to plan out of the 32% bracket, Alan. I'm betting if we did AI, we'd be getting that conclusion. That no matter how high the income is, we want to see if we can get out of the 32% bracket. To me, it just makes sense. So if you have a lot of capital gain, let's let's do an opportunity zone if we have to get out of that 32% bracket. If we have a lot of ordinary income, I'm going to ask Boo because he's the guru here. What am I going to do for a single taxpayer, a consultant, a real estate salesperson? We're going to do a defined benefit plan, aren't we? Remember, I've always said, and now I hope you'll believe me, what is 2 plus 2? It's 4 unless we're talking about a defined benefit plan. The answer an actuary will give is, what do you want it to be, Reg? And can we do that with a defined benefit plan? Yeah, by the way we write the terms. Now, some of you are going to have this situation because I've got it right now with 2 different planning situations. Somebody's selling a business and they're already 65 or 70 years old. They're thinking retirement. I'm thinking, well, let's not call you retired. What am I going to want to do? I'm going to want to change the sales price to put less on the sale of assets and put a ongoing income stream on the seller. Because then what am I going to do with the seller, Boo? I'm going to put a defined benefit plan on them. Can I wipe out all or virtually all of that ordinary income with a defined benefit plan? Yeah. I'm going to teach the world how to do tax planning for very high income consultants. Yes, Robin.
So in this scenario, we have the sell on 2 corporations. One of them is real estate, and the other is another business. On the defined benefit under the real estate, do all the rules for retirement plans and
Sure. Yes, they might. So sell the other corporation outright first, and then have the real estate one sell with a lot of income and less on assets. And on the real estate one, adopt past service rules. He's the only one still working from that point of view. Huh? Well, that's okay. Spouse is considered the same. Husband and wife, one. They can actually have 2 retirement benefits, but they are considered to be 1 unit. You should sell the other one first. He's not ready to retire. It's even better. He needs to sell the other company, or he's going to get the coordination rules. But that's doable. It's very doable. All right, you're down to. I have 3 minutes or 30. Oh, I'm in great shape. I could throw hot air at him for quite a while yet. So, our tax planning targets. We need to remember the silo. We would like to pay as little or no tax on Social Security, and we'd like to have capital gains at 0%. We can only do that if we're careful planners. But what things allow us to be careful planners? What things allow us to be careful planners? How about withdrawals from Roth IRAs? That allows for careful planning. The good news is the Social Security rules were written in the mid 80s, actually, pretty early 80s. The Roth rules were written in the late 90s, 15 years later or so. So Roth IRA withdrawals are not an add back for provisional income for Social Security. If you if you if evil Roger, the evil side of me, was hired by the government to write the rules, I would write them, but I would hopefully that never come out. I would write the rules to make Roth withdrawals part of a provisional income. But they don't include provisional income. They don't include loan proceeds. So between Roth and loans, I can give people the cash flow they need and not the income. So they can get not only deferral, maybe through a retirement contribution, but they can also get no tax on Social Security and no tax on capital gains.
The other thing you have to manage is the earnings.
So if anybody has the right contacts, I'm available to help write the AI program. Because this, I think, is going to be the future of good tax planning.
Absolutely.
And that's why I wanted to start with this 6 hours today. And I wanted to use it. I knew I couldn't do it completely. I wanted to use it so that I could build on it with my webinars through the year, where I show case studies, where I combine 2 or 3 or 4 of these techniques to save taxes. It can be done. It's going to be done. Somebody's going to do it. But it's not going to be a human brain, I don't think, alone. It's too complex. Think about this. In my PhD program, I had to take an inhuman amount of math. When I was an undergraduate, I took 2 calculus courses. When I was in the PhD program, I took 5 calculus courses. I was okay through about calculus course 3 in the PhD program. In calculus class 4, you needed to be an engineer because you were rotating things through 3 and 4 dimensional space. And I couldn't visualize. I just could not visualize. And you want to know how hard it was? I took a calculus, I think it was 4 class at Michigan State, got a 21 on the exam. I was blown away. Find out the average was 12. To me, that exam was ridiculous. And when I became a professor, I tried never to demoralize students on tests. But in the science departments and the math departments, they don't care if they demoralize the student. When I was an undergraduate at Nebraska, there were science tests, chemistry tests, that the average would be 25. Every time. And I remember thinking, I wasn't in those classes, thank goodness. I remember thinking, what does that do to a person's confidence? What does that do to their learning ability when they're that hard? That's why we're going to need AI. Absolutely why. When you start stacking all these opportunities that come from the tax bill that is the great new tax bill. I don't think many people have realized how big the opportunities are. I've been fortunate enough to run across them one at a time, Brad. And so I'm giving them to you multiples at a time. But I run across them one at a time. And at one at a time, it's easier to think, oh, opportunity zones are no big deal. Wrong, wrong, wrong. Because they're a big deal because of what they can do in the whole. Same thing is true of Roth conversions and Roth withdrawals. They're no big deal. Like fund, they're no big deal. Some of the wealthiest people in the world have great advisors who are telling them how to use Roth conversions. Reverse mortgages are no big deal. But we have professors at all the universities that have big financial planning divisions who maybe their number one or number two subject is reverse mortgages because of what you can do with them in terms of planning in combination with other techniques. Now, what I haven't done, and I'm about to finish, what I haven't done is tell you that this is not the limit of what we could do. Loans, for example. Somebody's got a lot of securities. They can do margin loans. Margin loans don't create income, do they? Well, not always even a high interest rate. Don't consider 7 or 8 a high interest rate. And that's the rate pretty much. Not in this world. Or even 10 or 11 if you're getting 8 or 9% back, giving up 11, but you're getting tax advantages. That could be a win. So you thought AI was not going to mess with us. It might replace us, Rich, or replace a lot of us. And I can do this. I cannot tell you how many times in my life I've been called a nerd. I was reminded of that Friday night at the Halloween party because I had somebody knew that I had been the financial person for the Methodist Church for 8 years on the foundation that was the largest in the country. North Georgia is the largest Methodist foundation in the country. I'm not Methodist anymore, but I was the person for 8 years. And some of the possibilities for planning are just outrageous and huge. So I think we're going to see more charitable planning, at least as long as there are people like me out there who can scream, charitable lead, charitable lead, charitable lead. I become a cheerleader this year for charitable lead trusts. Now, when 100% depreciation goes away, I won't be as excited about charitable lead trusts. But for right now, I am a huge fan of charitable lead trusts. And when you combine, but never until now could you get so close to $1 for $1, or even more than $1 for $1 out of a charitable lead trust. What's giving you that opportunity? No tax on Social Security, no tax on capital gains, etc. The charitable lead by itself can get 70 or 80% first year benefit. So if you get 70 or 80% of your asset purchase, Brad, with just the charitable lead, it makes sense if the charitable lead allows you to eliminate tax on Social Security and capital gains. It's an exciting future. That bad tax planning for now. We're going to take a break and then we're going to let Amy get up and talk about opportunity zones. I have invited Amy. They're one of our sponsors that's helped pay for your lunch and your books. I would have to charge you a good bit more for your books and lunches if I didn't have two sponsors. But I'm going to be very careful when I choose a sponsor, especially since I'm not a salesman. I'm going to be very careful in choosing something I strongly believe in. And I strongly believe in Amy's company, and I'm going to put you up to bat right after break. I'm done.